So good afternoon. Thank you very much for staying late into the day 2 of our conference. So we have a very small number of audience. So I'd like to make this as interactive as possible. So feel free to jump in if you have any questions during my talk. I'm the second from the last, and I feel sorry for my friend Damian Lim to actually conclude the conference, but he is very knowledgeable about regional investments, so I'm sure you will enjoy it. So stay tuned. So I'll try to make my presentation as short as possible and sweet. So in the next 20 minutes or so, what I'd like to cover is Sofinova's investment approach, and this is very Sofinova biased. And second, more generally, what investors are looking for. This is to sort of US biased opinion. And sadly, if I get a time to go through slides, then I'll probably venture to talk about opportunities for Asian biotech based on my ignorance, and hopefully I don't have to, then Damien can take that part. I have to say this because the one big disclaimer I have to make is even though I'm based in Tokyo as a part of Sofinova since 2007, we haven't executed Asian investments. We've looked at it, we are looking, and we'll look. It's just it's very hard for Pharma in Sand Hill to execute an Asian investment. So that probably tells a bit about the challenges we have in investing from US. So I'll start off by saying a bit about our firm. Sofinova Ventures is investing in life science since 1972. We have 1.4 billion under management, and we are currently investing out of our fund 8, $440 million we raised in October last year. We are one of the very fortunate groups to have been able to raise money, but for the country, it's a very tough environment, of course, for biotech to raise money, but for venture capital, it's the same. So it's taking significantly longer for us to raise money. Our investment strategy is different in that we focus on clinical stage investing. So we have 60 to 70% investing in so-called spin-outs, which I'll probably elaborate a bit more later. And as a result of that, we have over 50% of our portfolio in phase 3 or later. So we're fairly biased towards clinical stage investments. We have a fairly senior team, and we have presence in Asia, which is me. I'm based in Tokyo. In addition to our main office in Menlo Park, California, and we have a satellite office in San Diego. It's a quick snapshot of our investment team. So on the top, it's a core investment team supplemented by some of the past senior executives in biotech and pharma companies that have gone through significant drug development successes and failures, both in the product launches, and I'm covering Japan as well as Asia. So our investment orientation, as I said, is more biased towards late stage. So we do spin-outs, and spin-outs means we acquire a division. It's usually a program, a drug development program, and a team that knows the programs, or a single asset or a portfolio of assets from industry, which usually means large pharmaceutical companies or big biotech companies. These investments tend to give us lower technical risks and shorter time frame to an exit, so that's preferred by investors, obviously. And the rest we balance by investing in more high science, typical university spin-out type companies. So we acquire university technologies or products from institutions. These are type of novel and disruptive science, which sometimes called a platform that can create multiple programs. In exchange for higher return multiple, we will take higher technical risks for those type of investments. So in terms of segments that Sofinnova likes to invest, we can put into two buckets. One is typical biotech, and the other is growth. It's non-prescription type of investments. In biotech, we like specialty pharma space, and that tends to be a market of $200 to $1 billion typically, and can be addressed by a sales force of less than 100 people. The therapeutic categories that falls under this includes ophthalmology, dermatology, and women's health. We have had good successes in this, investing in these segments. Recently, Vicept is a derma company acquired by Argan. Movitis is a GI company that was acquired by Shire. And Previum is a women's health company that was acquired by Gedeon Richter. The second part is in the biotech is a blockbuster pharmaceutical markets. Obviously, that generates multi-billion markets, but requires primary care sales force, and usually phase 2, 3, or sometimes phase 2 are daunting and very costly. So it's prohibitive for biotechs. But we do invest with significant caution. And Amarin is a good example of our investments in the cardiovascular space. The therapeutic areas, as I mentioned, specialty pharma is the one that we really like, because the development timeline and the required development costs are reasonable within the venture dollars. And there's a tight set of potential acquirers, Shire being one of them, who are very active in looking at buying companies. So an exit is fairly projected. And if there's no acquisitions at the point, then we can still take molecular drug programs for product launch with venture dollar, which is usually less than $100 million. And build a small sales force. And once you get to a revenue stage, it's much easier to actually get acquired or get a valuation which is fair in the current IPO markets, public markets. We tend to like anti-infectives. Some pharma companies don't exit it from the space, but because it tends to give us a lower development hurdles and the risk are somewhat lower compared with other therapeutic categories. We tend to have some investments in this category. Oncology we look seriously because including Japanese pharma companies, there have been activities in partnering and acquisitions. And Intecan is the one that we actually just sold to Takeda Pharmaceuticals January this year. So the company has a program that's targeting sort of hot targets that pharma likes, and there's a reasonable development path with reasonable development investments. Then that could be interesting to us. Cardiovascular metabolic space is, I think it's getting very challenging, and I think many of our venture colleagues share the same view because of the regulatory hurdles. That the bar has been very high these days. One of our companies, Orexian, obviously met that hurdle, so have struggled, but still continue to do the program. But those are difficult areas to, especially type 2 diabetes. Even big pharma companies are partnering amongst themselves. So it's very difficult for venture investors to invest in type 2 diabetes companies these days. There are some areas that we still consider investing in metabolic space, one being maybe metabolic diabetic complications and some of the renal indications that may not require huge phase 3 investments. And we'll also look at other therapeutic areas opportunistically. So we talked about Sofinnova Ventures' biased investment approach, and now I'll probably address more broadly about what I'm hearing from other venture colleagues, and there are a couple of key themes that they are looking for when approaching new investment. So I'll share some thoughts. So those are sort of the usual. I mean, medical needs a sound scientific basis as a preclinical or clinical quality of the package, a competitive product profile of existing or in development programs, a strong IP portfolio, and a clear regulatory path to approval. And last but not least, proven management team. And to be very frank, we've looked at some of the Japanese biotech investment opportunities, and our partnership can't really get through it because we tend to like to work with past CEOs who have made money to us, and there are so many U.S. entrepreneurs associated with Sofinova who are starting new companies. So if you you have more confidence in these companies, and there are so few Japanese biotech entrepreneurs that have had multiple success just because of the history. It's just the length of the history, biotech history in Japan or other parts of Asia. So there's really nothing wrong with it, but it takes time for U.S. investors to digest this particular criteria. So this is the usual. But I think the environment has changed, especially post 2008 Lehman crisis, as some of our prior speakers have mentioned. Exit opportunities are very limited today. IPO environment in US and EU are very unfavorable, and I would assume that maybe in Shenzhen or Hong Kong, you can get easy an IPO, probably. You can still get an IPO for a select few quality companies, but usually you have to get IPO done at a discount to the pre-IPO valuation. Therefore, you don't really actually make return at IPO, and you have to hope that post-IPO and becoming a public company, the investee company can deliver and achieve a value inflection point, thereby the company is fairly valued in the difficult public market. And because IPO markets are so difficult, as many of you are aware, I mean, M&A gets more popular exits, but you only see so many M&As per year, and even Pfizer can probably consume, I think, 20 or less. So basically, that will only apply to very few companies. And cost and risk of drug development are increasing, partially because of the regulatory hurdles that's increasing, probability of success decreasing due to hurdles and trials. So those are some of the challenges that we have been facing in recent years. So some of the common themes that we see beyond the usual criteria that the venture capital firms apply. I think number one is capital efficiency. And we used to be investing 100 million pre-IPO, and we can get 300 million market cap in public market, and we can actually make decent return. These old days are obviously over post Lehman or even pre-2008 Lehman crisis. So we have to think how we can actually invest maybe $50 million or less and achieve exits or returns to our investors, which is challenging. I mentioned a bit about the company, cancer company called Intellikine, and they have had 100% owned China-based American subsidiary called Chemokine, and their fully loaded FTE was actually significantly lower than the typical WuXi's and Shannon Pharmas of the world. So this company, from 4 years from the inception, was able to put 3 NCEs into clinic with only 40 million venture dollars, and became a part of Takeda now. So this is a sort of a capital efficiency that we love to see as a venture investor. And as I said, exit is important, and we have to have an exit in mind at investments. So sort of have potential buyers, for example, we have to actually think when we invest. And there has to be one or two credible buyers down the road. Otherwise, it's very difficult for us to execute investment. Other thing that we hear, I think, if you were in yesterday's session, the investment is also very challenging, and requirements from our pharma partners. And we continue to hear from our pharma colleagues. Getting product approval is not enough. You have to have reimbursement strategies in place, and the company can articulate these strategies when they approach a partner or a potential acquirer. And pursue different funding mechanisms, including non-dilutive financing, and creative collaborations are important. So because the first two bullet points are important, I'd like to elaborate a bit for the rest of 5 minutes or so that I have. So capital efficiency. Now you can do early investment, but you don't have to be investing in high science and take science risks. It's a Series A investment, but invest into mature assets. And a typical example is spin-outs, which is what Sopinova has been doing in decades. There are some new ways of structuring companies to allow easier and earlier return to investors. And one form is to create the companies in the form of limited liability corporations compared to the typical C Corp. This is obviously US. And there's significant tax implications. And if you set up a company in LLC, and Adimab is a company, it's an antibody platform company based in the East, and they're actually generating revenues and profitable, so they actually can pay returns to investors by the form of dividend without a significant tax at the corporate level. Another creative way that we have seen is disconnecting discovery and development programs and put into two different entities. There's a company called Pharma. It's I think it's a staple peptide company. It's a protein-protein interaction space. They've done a big deal with Genentech. And the particular programs that they've done with Genentech, they put into a separate entity. And the revenues that comes from Genentech is now being distributed to investors. And the Pharma, as a platform company, is a separate entity. The existing investor continue to invest so that they can create more value. So these two entities are very different time horizon to investment and the risk reward profile. And project financing has gained some popularity in recent years. It comes from various forms, but typically they are highly virtual company, and they tend to have a single asset. And usually the structure is such that there is a pharmaceutical company sponsor who actually outlines a program to project financing vehicle, and they partner with CROs or whatever to actually develop drug to the point to either proof of concept or regulatory approval, whichever is pre-agreed by the two parties. And if successful, and only if successful, they get paid some investment multiples. And those investment multiples tend to be higher, single digits, so it's pretty attractive. And this is capital efficient because the company can focus on one asset. They don't have to worry about partnership. They are working towards a fairly well-defined milestone, and they have to think about IPO or an exit. So tend to be pretty capital efficient. So the second bullet point that I'd like to address is built with the exit in mind. In the days of if you build it, if you build it and they'll come, all days are over. And you have to actually have the exit in mind from the day one. And from the investor viewpoint, this is one of our key diligence items. And if we are looking at an investment, we actually call our pharma BD colleagues and tell them what type of programs we're looking at, stage, mechanism of actions, if not confidential, and what types of trials we run, and try to achieve primary endpoints, and ask them if they like this type of program, if successful. And we tend to get fairly straightforward, honest answers. And sometimes we have some interesting input as to what type of trials or design what we should run. So this is something that we do quite often these days. And there's a mechanism in which you can actually build a potential exit into the financing in the form of predetermined buyout options. So you have one potential buyers already identified when investing. And Novartis has an option fund with NPM that solves the needs of this. And a more recent example, which I see is interesting, is that there's a group called Third Rock, Boston-based venture capital group, which partnered with Sanofi and created a new co called RAPDrive, in which Sanofi has committed to invest in 150 million in the form of equity plus development funding. And Sanofi has a co-option to buy the companies when a certain milestone is achieved. And investor group has a put option to actually sell the company to Sanofi if a certain milestone is met. I don't know the detail, but this sounds like a very interesting way of having at least one potential buyer who is very committed. So that basically hedges the risk of exiting. And the more soft way of doing is forming closer tie with potential end buyers. And as some of the previous speakers have mentioned, our financial investors like to have corporate venture groups as core investors always. And Novartis is actively investing in Korea, as I understand it. And Japanese pharma companies have corporate venture group who I believe are looking at Asian as well as US and Europe from Astellas, Takeda, and Mitsubishi Tanabe. So these are the great group to have. And from our venture side, we are doing a lot of business development on behalf of our investee companies. Part of BD is when we do due diligence, we actually call the companies, and at that time we introduce potential investment, and that becomes sort of the initiation of relationship with pharma company. So for us, 3 years ago, we never did anything with Pharma BD group. I think these days, most of us do a lot of business development. And Japanese pharma companies as a group have emerged as a very credible companies that actually partner by biotech companies. So in Tokyo, I've been spending a lot of time with Japanese Pharma BD groups. So so it looks like I didn't have to speak the final point, to which I think Damien can speak. I'll let you know what it is. So in summary, it's very challenging time to raise money for biotech, but for us venture capital as well. And each VC has very different biased investment approach, so there's no one-fit-all criteria. We've talked some of the key themes. I think capital efficiency is one of the key because you can't really expect to invest 100 million. We like to see some of the strategies to de-risking in developments, and obviously have to have exit strategy from day one, and it's not too late to think about it. So with that, so this is what I was going to talk about. I don't have time, so Damien can talk about it. So with that note, thank you so much for your attention, and I'll be happy to take any questions.